Gold has been marked down, silver has been marked down whenever oil goes up because, oil is going to go up. So this is bad news for inflation, it's bad news for this, that, and the other thing. Therefore, gold is going to be sold. Anything really below about 410,000 contracts, open interest, in the gold contract, you would say is an oversold market, one where basically speculation is absent. Some of the bullion banks will have long positions in London, covering short positions on COMEX, but they've really run out of sellers of gold and silver in the West, in the G7 countries, particularly New York, London, and Switzerland. Gold's going higher. You should have 20% of your portfolio in gold, virtually nothing.
Yeah, are you worried? So, for example, Turkey had to sell quite a large portion of their gold recently, and it had a big impact on the markets.
The commercial banks actually have customers who want this gold. They have stolen that earmarked gold. America has taken that gold for its own uses. Federal Bank of New York and say, we can't deliver our gold and pay us.
Have you been surprised how gold and silver maybe hasn't reacted as you'd expect they would react in such a volatile environment? It seems like they've almost been used as liquidity versus potentially a risk haven during this volatility.
Yeah, no, it doesn't surprise. I've written about this a few times. Basically, it's very, very simple. A portfolio manager, and we're looking at about, portfolios in North America are reckoned to total about $160 trillion worth. Now, what's the safe haven for a portfolio manager? Well, cash, obviously, because he accounts in dollars, whether it's Canadian or American dollars. So if he thinks there's an awful lot of risk around, he sells assets for cash. He doesn't sell it for gold, he sells it for cash. So that's really why you've seen, gold has been marked down, silver has been marked down whenever oil goes up because, oil is going to go up. So this is bad news for inflation, it's bad news for this, that, and the other thing. So therefore, gold is going to be sold. That's the view they take. Now, how much selling of gold is actually occurring is extremely low. You've only got to look at the open interest on COMEX for the silver contract in particular, but also gold, to see that they're historically very low levels. I mean, silver has been down to levels not seen for 20 years. Gold, similarly, has been extremely low, but not quite as low as silver. But, it sort of bottomed out at something like 360,000 contracts.
Markets are screaming risk off. Yet institutional money still treats cash as safer than hard assets. And that contradiction should concern every long-term saver. Alasdair Macleod notes that North American portfolios now sit near $160 trillion, while COMEX open interest in silver has collapsed toward multi-decade lows, signaling apathy rather than panic selling. The real story is liquidity preference, not investor conviction. Wall Street keeps dumping paper exposure because benchmark managers are trapped defending quarterly performance, while physical demand underneath remains unusually tight. Next, Alasdair Macleod exposes why the recent oil-to-gold correlation breakdown may signal that institutional selling pressure is finally exhausting itself.
Given anything really below about 410,000 contracts, open interest in that, in the gold contract, you would say is an oversold market, one where basically speculation is absent. There's a bit of a recovery going on there now, but the idea that anybody's really got much gold is completely wrong. Things get marked down because of the vested interest, if you like, of the shorts. You've got the swaps and the market makers who are all short on COMEX. They may be long in London. Some of the bullion banks will have long positions in London covering short positions on COMEX. But the short positions on COMEX basically mean that, what do we want to do? We want to mark it down. Basically, shake out any loose stock that may still be around, but also on a valuation basis. When it comes to the end of the month, end of the quarter, whatever, we can tell our bosses that the position has improved from last time. That's really what it's about, Anthony. Nothing material. And I tell you something, this has now shown signs of changing because yesterday we had oil rise. I think oil rose something like 4%. Not huge in the scheme of this volatility, but nonetheless a very definite rise. And what happened to silver? Silver rose 8%. Recently, it's been oil rise, precious metals down, and vice versa. Now it's changing. And I think what that means is that they've really run out of sellers of gold and silver in the West, in the G7 countries, particularly New York, London, and Switzerland.
Silver jumping 8% while oil rose sharply is not normal behavior for a market supposedly driven by inflation fears alone. According to Alasdair Macleod, gold, open interest below roughly 410,000 contracts, historically signals a washed out speculative environment where institutional positioning becomes dangerously one-sided. The public hears weak metals, but market makers may simply be defending short exposure into quarter-end reporting cycles. That matters because once physical sellers disappear, paper suppression mechanisms lose effectiveness fast, leaving underallocated investors exposed to violent repricing. Next, Alasdair Macleod reveals the hidden imbalance between institutional goal recommendations and actual portfolio allocations inside major banks.
So, yeah, I think this is actually a very, very material change. And so what we're going to see, I think, is very shortly we're going to see at $160 trillion of portfolios begin to realize that its exposure, I mean, if you look at the ETF exposure, it's 0.2%. They've got some mines and all the rest of it. There's probably an average exposure of ETFs and mining sector running at about 2% of that 160 trillion. Where's the rest? The rest is in tech stocks, in things which basically are in a bubble. So that you're going to get a very major shift, I think, in portfolio allocations, and they're not going to go into bonds, I can tell you. And it's interesting because Bank of America, Morgan Stanley, and all the rest of it have been saying, 20, 25%, whatever should go into gold. And they run trillions of discretionary funds, for very high net worth individuals. And have their investment managers got any gold? No, they have their hellers like. Yet, the strategists in the banks are now saying, yeah, gold's going higher. You should have 20% of your portfolio in gold. They've got virtually nothing.
Yeah, are you worried? So, for example, Turkey had to sell quite a large portion of their gold recently, and it had a big impact on the market. So, is that a risk where, in the future, if governments hold a large portion of their reserves in gold, if they're in financial distress, they might have to sort of dump them on the market, and there could be risk there?
Banks publicly recommending 20% gold exposure while holding almost none internally is the kind of contradiction retail investors usually notice too late. What Alasdair Macleod is highlighting here is that ETF and mining exposure across massive discretionary portfolios may still sit near just 2%, despite non-stop inflation and debt warnings. Institutions keep selling the diversification narrative while remaining overwhelmingly concentrated in inflated tech and credit assets. If even a small portion of that $160 trillion rotates toward metals, current paper pricing models could become completely disconnected from physical demand realities. Next, Alasdair Macleod unravels why Turkey's gold-selling headlines may actually conceal a deeper monetary strategy.
Well, Turkey is I think, a special case. I've been in Istanbul once, and I had this discussion with some commercial bankers. And it appears what happens is that the Turkish central bank uses gold very much as a means of regulating its own currency. So the reason that it sells gold basically is to buy its own currency, to support its own currency in the markets. And then it buys it, then it'll buy it back at a later time. So that's it. It's using gold quite dynamically in that sense. But when it sells its gold goes to commercial banks. It doesn't go into the market. The commercial banks actually have customers who want this gold. So there is a bit of the sort of ebb and flow between the commercial banks and also the central bank. So I think to look at, sometimes they sort of come out and say, oh, last month they sold 60 tons of gold or whatever. Take it with a pinch of salt. It really doesn't matter. They're not the Turks. The Turks actually use gold quite sensibly in that sense. I mean, they're lousy at managing their currency, which collapses and collapses and collapses. But they have got slightly some sort of message in terms of, here is a monetary asset which we can actually proactively use. And the commercial banks understand that as well. Unlike our commercial banks don't want to touch bullion because they're not in the business of bullion. They're not in the business of physical stuff. They're in the business of credit.
Every time headlines announce central bank gold sales, markets assume weakening demand. Yet the actual gold often never reaches the open market at all. Alasdair Macleod's argument suggests Turkey is using bullion as a live monetary stabilizer, cycling metal through commercial banks to support its collapsing currency, without abandoning physical ownership. That timing matters because Western banks increasingly avoid physical bullion entirely, preferring credit creation over tangible reserves. Savers watching fiat purchasing power evaporate should notice which systems still treat gold as strategic collateral rather than a speculative trade. Next, Alasdair Macleod reveals why COMEX delivery fears could expose a much larger credibility crisis inside Western banking.
They will create credit and they make money on the credit spread between what they create and what they have to pay to balance their books, which is a lovely game. Don't disturb it. We're not going to do what the Turks do, I can assure you.
Yeah, and then we're seeing the challenges that the COMEX is having with potentially, defaulting on some of their physical deliveries, or that's what there's risk of happening. And we saw that with the French requesting gold from the US, and that was settled in cash. So it's quite interesting, all these phenomena.
I think that was a brilliant move by the French. I really do. And I mean, if I was a German central banker, I would do exactly the same, because we know that they have stolen that earmarked gold. America has taken that gold for its own uses, and consequently, it's not there. I mean, we got this message very clearly when the Americans said, "We will deliver to you, Bundesbank, was it 300 odd tons? It's going to take us 7 years to do it." What? It's our property, and it's actually in your bank, earmarked as our property. We want it back. No. So you had negotiations, if you like. Behind the scenes, it is absolutely clear that the Americans have not got that gold. They have taken other people's gold and stolen it and used it for their own purposes. I won't go into what those purposes are. That's not the point I'm making. The point I'm making is that the Bundesbank should now turn around.
If custodians truly hold your gold, it does not take 7 years to return it. And that delay alone should alarm sovereign reserve holders everywhere. This is where Alasdair Macleod's thesis shifts from market structure into institutional trust, questioning whether portions of Western gold reserves have already been rehypothecated beyond recovery. The media frames COMEX stress as a technical delivery issue, but the deeper risk is a confidence itself. Once investors suspect physical backing is thinner than reported, paper claims can unravel much faster than policymakers can contain. Next, Alasdair Macleod exposes why cash settlements may quietly reveal the difference between owning gold and merely having a gold promise.
To the Federal Bank of New York and say, right, if you can't deliver our gold, then you can sell it in the market and pay us. Of course, they won't sell it in the market, but they will create the dollars to pay off the Bundesbank. And then the Bundesbank just goes into the market. That's good. I mean, that's got to be the sensible thing. The problem is that the liquidity in the market, even we're talking about gold, with a theoretical above ground stock of about 200,000 tons, the market isn't that great in gold. I mean, there's just too many people demanding gold at the moment. So I think the Bundesbank would be very frightened to do that, but they would have had the opportunity to do it. And well done, France, for doing it. I mean, really, the French actually have a pretty good record of understanding gold. I mean, go back to de Gaulle back in the 60s. He said, no, we want our gold back. We don't want your dollars. And that was actually the thing that destabilized the London gold pool in the mid to late 60s and led eventually to the abandonment of this crazy Bretton Woods system, which America just abused.
Yeah, super interesting. So, Alasdair, thanks so much for your time today. We covered quite a lot. But my last question is, what is one message people should take away from our conversation?
Subscribe for my Substack. And stay informed. I mean, you understand the difference between money and credit. As the great banker John Pierpont Morgan said way back in 1912, gold is money and all else is credit.
Gold markets supposedly contain over 200,000 tons above ground, yet central banks still appear terrified of demanding immediate physical delivery. As Alasdair Macleod points out here, the issue is not total supply, but accessible liquidity, because much of that metal is tightly held and unavailable at current prices. That completely undermines the mainstream assumption that paper claims and physical gold are interchangeable assets. For long-term savers, the danger is realizing too late that settlement in dollars during a currency crisis may preserve nominal value while destroying purchasing power. Next, Alasdair Macleod exposes why historical gold repatriation battles shattered trust in the Bretton Woods system itself.
He's dead right. That's the legal position, despite what governments say. I mean, governments turned around after that, sometime after that, 20 years after that, and said, you cannot own gold anymore. You have to submit the gold to the US Treasury or the Federal Reserve Bank or whatever. Despite those sort of, if you like, rules that are introduced from time to time by desperate governments, the common law position is gold is money and all else is credit. And that, incidentally, includes currencies. And what we are seeing is a flight out of credit into real money without counterparty risk, which is gold and possibly also silver. And more than that, China realizes the mess that America's got into and realizes that its currency will become completely valueless. And so what she has done is she's put in place the means to protect herself from this disaster. She's opened gold, SGE, Shanghai Gold Exchange, vaults outside China for the first time. I mean, some people would think it was inconceivable. But she's opened a vault in Hong Kong. Hong Kong's ramping up its dealing in gold as well, setting up a new futures market, and also a vault in Saudi Arabia. Why? The point about these vaults is that you can buy and sell gold for Chinese yuan using these vaults, if you like, as storage for gold. And I mean, at a drop of a hat, the Chinese can turn around and say, right, for international trade purposes, there is now a fixed rate between gold and the yuan.
China is building offshore gold infrastructure, while Washington still insists the dollar system remains unshakable. And both positions cannot be true simultaneously. Alasdair Macleod notes that Beijing has expanded Shanghai Gold Exchange vault access into Hong Kong and Saudi Arabia, creating channels for gold settlement outside Western banking control. This is not symbolic diversification. It looks more like parallel monetary architecture quietly forming before a confidence event hits sovereign debt markets. Investors focused only on CPI headlines may miss the much bigger transition already happening underneath global trade settlement systems. Next, Alasdair Macleod reveals why tying gold to yuan-based trade settlement could fundamentally alter commodity pricing power worldwide.
Of X. To put it on a Bretton Woods style gold standard for international trade purposes. Now, I think they should extend it further and actually put the domestic yuan on a gold standard as well, and do away with exchange controls. But that's probably a dream too far as the Chinese are concerned. But I do see them protecting themselves from a collapse in the currency. The Western currencies, call it the G7 currencies, by ensuring that they have enough gold and they have the facilities for people to exchange gold for yuan at a fixed rate. That, as far as I'm concerned, is going to happen, and it's going to happen quite soon. And if you look at Chinese actions, they've been accelerating their disposal of G7 currencies in return for gold, in return for silver and other commodities. They've also taken action to protect their own economy from the disaster that the Americans have created in the Gulf by stopping the export of fertilizers, for example, stopping the export of copper and various other metals. I mean, it started with rare earths, and silver obviously was included in the same thing, which we didn't know at the time. But this is going to take quite a lot of commodities out of the world. I mean, it really is. And combination, if you like, of loss of fertilizer from downstream oil production in the Gulf, plus countries like China deciding, well, we're not going to export any of ours because we need it for our own economies. I mean, it's really going to be very, very bad. I mean, for the Europeans, for emerging markets around the world as well. It really is not good.
Western policymakers still talk about stable globalization, while commodity export restrictions are quietly accelerating across multiple strategic sectors. According to Alasdair Macleod, China's aggressive conversion of G7 currencies into gold, silver, and hard commodities suggests Beijing is preparing for monetary fragmentation rather than economic normalization. That flips the mainstream narrative completely because supply shocks are no longer accidental disruptions. They increasingly resemble deliberate national security positioning. For retirees and savers, persistent shortages in fertilizer, copper, and industrial metals eventually translate into higher living costs and weaker currency purchasing power. Next, Alasdair Macleod unravels why rising commodity prices may reflect collapsing trust in fiat settlement systems more than ordinary inflation.
And another thing is that the export of sulfur for sulfuric acid has been very heavily curtailed, and consequently, the refining of copper ore and various other non-ferrous ores in the rest of the world is going to be very, very badly compromised. So what happens to all those commodities? They shoot up in price simply because there isn't the supply. This mess just cannot be swept under the carpet, and it's turning out to be a lot worse than any commentary so far has really begun to understand.
Yeah, definitely. And how could China actually have a fixed sort of gold to yuan? Wouldn't there be massive arbitrage opportunities, especially with other fiat currencies and conversions and whatnot? I feel like that could be a risk for them to do.
No, I don't see that at all. I mean, the answer basically is that if you have a drain on your gold reserves, then you raise the interest rate. What that means is that your currency acting as a gold substitute, in other words, if it is as good as gold, then the higher interest rate will cause a flow of gold from other centers with lower interest rates, if they're tied to gold. And of course, because none of them are tied to gold, basically, what's the interest rate on gold? It's the lease rate, which is 0.5% or 1% or something like that. All they need to do is have an interest rate at 3 or 4, 5% in order to stop a run on their gold reserves.
Commodity bottlenecks are spreading into chemical processing and metal refining, yet most financial media still frames inflation as a temporary demand problem. What Alasdair Macleod is highlighting here is that China could theoretically stabilize a gold-linked trade system through interest rate defense mechanisms long understood under older monetary regimes. That historical echo matters because fiat systems today rely almost entirely on confidence rather than redeemability. If confidence weakens while physical supply chains tighten simultaneously, traditional stock and bond diversification strategies may fail precisely when retirees need stability most. Next, Alasdair Macleod exposes the overlooked scale of China's long-term gold accumulation strategy dating back decades.
And I would also argue anyway, their gold reserves are absolutely enormous. I think, you're looking, what's on balance sheet, as it were, in the PBOC's official reserves is just a tiny part of the total. They've been spiriting away gold since 1983 and had the opportunity to do it in huge quantity. I estimate that by 2002, when they then permitted individuals to accumulate gold, they were banned from it before then, and the Shanghai Gold Exchange was open to facilitate public participation in gold. By then, I reckon they'd accumulated something in the region of about 20,000 tons, and they haven't stopped accumulating. They rapidly became the largest gold mining nation by far, overtaking South Africa, I think, in about 2007.
If China has quietly accumulated anything close to 20,000 tons of gold since the 1980s, global reserve dynamics may already look completely different behind closed doors. Alasdair Macleod's argument suggests official PBOC disclosures could represent only a fraction of actual sovereign-linked holdings accumulated through decades of mining expansion and strategic imports. Meanwhile, Western governments continue expanding debt issuance while downplaying the importance of hard reserves publicly. Investors depending entirely on fiat-denominated retirement assets should pay attention when nations with long planning horizons keep converting paper claims into tangible monetary metal.